The Fed didn't raise rates. It didn't lower them either. It did something worse. It froze them. And that one decision, it's quietly nuking the real estate market from the inside out. And no, this isn't another housing crash video. It's not about prices tanking or people defaulting. It's about something that you're not seeing until it costs you everything. This affects your house, your rent, your future. So stay with me, because what just happened to my buddy John could happen to you next. Right now, 65% of US banks just tightened construction lending. Translation, builders can't build, projects stall. And if you think that means prices are about to drop, you're playing the wrong game. This quiet collapse didn't start with headlines. It started with a decision. The Fed kept interest rates pinned at 4.5%. Not up, not down, just stuck. And in 2025, stuck means dead. The Fed's own survey exposed it. Construction lending standards jumped from 4.8% to 14.3% in just one quarter. 12 straight quarters of tightening credit. That's historic. And tariffs, they're adding over $9,000 per home. Inflation still rising. Core PCE just hit 3.5%. And banks, they're bracing for impact. Jamie Dimon said it himself. The economy is encountering significant turbulence. I've watched 3 of my own development partners walk away from million-dollar projects in the last 60 days. Not because the deals didn't pencil, but because the funding wasn't there. One told me straight up, it's not worth the risk anymore. And regional banks, the ones who fund local development, are quietly slamming the brakes. Fifth Third, Citizens, Regions, they're freezing credit lines, only funding their best clients, drowning the rest in red tape. This isn't just inconvenient, it's killing deals before they ever break ground. The National Association of Home Builders just reported the slowest rate of new starts since 2012. In March 2025, single-family starts dropped 14.2% from February, down 9.7% from last year. Even the big dogs are hurting. Toll Brothers says demand is falling. Lennar's earnings are slipping, and D.R. Horton slashed its forecast big time. The latest survey says 72% of builders had their loan-to-value ratios cut. 61% had their loan limits reduced. That's not a soft landing. That's a brick wall. And the impact goes deeper than stats. Fewer homes means tighter inventory. Tighter inventory means prices stay high. And not just for buyers. Rents are spiking, vacancies are falling, and affordable housing, it's vanishing. The hardest hit? Young families, first-time home buyers, renters scraping by. Over 50% of renters are already cost-burdened. That number is rising fast. Projects are getting canceled before they even begin. Affordable and multifamily developments wiped out by financing delays. Cities like Charlotte are bailing out housing projects just to keep them alive. Permits are stalled. Costs are exploding. Developers are walking away. Experts now say we're 7.5 years behind on housing supply, and that's if things improve soon. I've been tracking this since 2018, and I've never seen the gap this wide or the opportunity this clear. So here's the truth. If you're waiting for prices to drop, you're gonna miss the boat. This isn't just inflation. It's a slow motion lockout, because when supply dries up and funding slows to a crawl, the only people buying are the ones who already own. So if you want in before the door slams shut, you need a funding strategy that works right now, not one that worked 5 years ago. Here, let me show you what this looks like in real life. Meet John, my buddy I told you about. He runs a construction company. Good team, solid track record, nothing sketchy. He's got a great reputation. He lands a big government contract, game changer. It would set him up for years. Only problem, he needs one key piece of equipment before he can start. So he goes to the bank, applies for a loan. Credit's solid, business is healthy, everything checks out. And then he waits and waits and waits. Paperwork, more reviews, final committee approvals. Meanwhile, the clock ticks. The project deadline doesn't budge. If he misses the start date, he loses the contract. Penalties eat the profits, and the whole thing vanishes. And that's what happened. John lost the deal, lost the momentum, lost a future he already earned. All because the money didn't move fast enough. And he's not alone. This is happening everywhere. Small and mid-sized companies are getting crushed. Not because they lack opportunity, but because banks are playing by old rules in a new world. Harvard's Housing Studies Group just reported that project financing delays have doubled since 2023. So if you're still counting on traditional banks, you're gambling with your future. Let me be clear though, real estate still works, ownership still works, cash flow still works, but only if you can move when the deal's hot. The problem isn't the deal, it's the delay. Most people think capital is guaranteed. It's not. And that assumption, it's killing growth. So what's the fix? Is it ditching construction? Is it never borrowing? No. It's changing the way you fund. Because banks are moving slower than ever. And most people are still following advice that stopped working in 2018. But there's a smarter way. I know investors right now getting funding in days, without gatekeepers, without delays. They're using assets that banks typically overlook, deal structures that create instant leverage, and tools like loopholelending.com to unlock 0% interest credit. If you've got a 680 credit score or higher, you could qualify for up to $150,000 in funding right now with no interest for 18 months. And no, it's not too good to be true. It's just not mainstream. And that's the point. John didn't fail because he wasn't ready. He failed because the system isn't. But you don't have to. This isn't just a market shift. It's a once-in-a-decade moment. The Fed made its move. Now it's your turn. Because the winners in this economy aren't the ones who hustle hardest. They're the ones who fund fastest. In my next video, I'm going to give you another source of funding. Seller financing. I'm going to give you 6 seller financing hacks that I wish I knew when I was a beginner. But for now, if you like this video, YouTube thinks that you're going to like this one right here too. So click it, check it out, and I'll see you over there. Thanks for watching. Take care.